U.S. job market, cooling off noticeably. This week, the U.S. labor market delivered a dose of reality that the red-hot hiring boom of the past 2 years is truly downshifting. The August employment report, released at the very start of this period, showed that job growth has slowed to a crawl. Only 22,000 jobs were added in August across the entire country. That's anemic compared to the 200K plus monthly gains we were seeing a year ago. In fact, over the summer, monthly job gains have averaged under 30,000, a dramatic comedown from 2024's pace. Additionally, revisions to earlier data revealed a shocker. The economy actually lost jobs in June, about 13,000, the first net decline in payrolls since December 2020. So what's going on? Businesses, facing higher interest costs, uncertainty from trade tensions, and maybe sensing consumers pulling back, are becoming more cautious in hiring. We're hearing phrases like companies hunkering down and refusing to hire unless absolutely necessary. Some sectors are outright shedding jobs. For instance, manufacturing has been losing jobs for 4 months straight, reflecting weaker demand and the impact of tariffs raising input costs. Other sectors with job losses include retail, transportation, information, tech and media, finance, construction, and even professional services. This is a broad cooling. The unemployment rate ticked up to 4.3% in August, which is nearly a 4-year high, the highest since late 2021. Just a year ago, unemployment was around 3.5%, so this is a significant rise, though 4.3% is still historically quite low. The uptick partly came from more people entering the workforce, which can push the rate up if not all find jobs immediately, and partly from some people losing jobs. Notably, the number of people unemployed for long stretches has grown, and the average duration of joblessness extended to about 24.5 weeks, suggesting some folks who lose jobs are finding it tougher to land new ones quickly. Also, the share of people who are permanently laid off, as opposed to temporary layoffs, has increased, hinting at more structural adjustments in the economy. It's worth pointing out that some of this cooling is intentional, or at least anticipated, as a result of the Fed's rate hikes. A slower labor market helps ease wage pressures and inflation. But there are also policy-specific factors blamed. Economists in one report bluntly pointed to President Trump's economic policies, especially high tariffs and strict immigration crackdowns, as contributing to slower growth and even job losses. Tariffs have raised costs for manufacturers and exporters, dampening hiring, and reduced immigration can tighten labor supply in some industries, though ironically it can also push wages up. Furthermore, there have been government spending cuts and public sector layoffs. Federal payrolls dropped by 15,000 in August, and since January the government workforce is down nearly 100,000 jobs due to budget cuts in DC. All of this has led one economist to quip that the economy is skating as close to the edge of recession as you can get. Indeed, recessions in the U.S. historically often coincide with the unemployment rate rising a full percentage point or more from its low. We're about 0.8 percentage points above the cycle low now, so everyone is watching closely. For the Federal Reserve, as we discussed, this weak jobs data sealed the case for a rate cut in many observers' eyes. Essentially, the Fed's mandate includes maximizing employment, and if the labor market is faltering, the Fed has reason to provide stimulus, especially since inflation is not out of control anymore. The logic is straightforward. If companies are shedding jobs and unemployment is rising, the economy needs a bit of support to avoid slipping into a downturn. The president has been hammering that point too, blaming the Fed for being too slow and calling Chair Powell too late, in classic Trump fashion, for not cutting rates sooner. Now, let's talk wages. Despite the slowdown in hiring, wage growth has been decent. In the August report, average hourly earnings for American workers rose about 0.3% over the month, and are up roughly 3.7% compared to a year ago. That annual pace is a bit cooler than it was earlier. Wage growth was near 4.5% last year, but it's still outpacing inflation, which, as we noted, is tilde 2.9% annually. That means real wages, after inflation, are finally rising modestly. For much of 2022 and 2023, inflation was so high that even 5% wage growth left workers behind, but now pay increases are slightly above inflation, giving workers a tiny increase in purchasing power on average. However, 3.7% wage growth is not exactly torrid. It's consistent with an economy that's not overheating. And it might cool further if the job market continues to loosen. We're starting to hear fewer stories of employers offering big sign-on bonuses or bidding wars for talent, except in certain still hot niches. A positive spin. Wage growth easing could help the Fed feel comfortable cutting rates without fear of a wage price spiral. One more labor story from the US, revisions and controversy. The Bureau of Labor Statistics, BLS, had to revise down job gains for the spring by quite a lot, over 250,000 fewer jobs than initially reported for May and June. This so angered the administration that President Trump actually fired the head of the BLS, an unprecedented move that raised eyebrows. He accused the agency of messing up the data, alleging manipulation, though there's no evidence of that. The new interim head he picked has been critical of the BLS and even mused about suspending the monthly jobs report, which, to be clear, is a vital economic indicator. This drama doesn't directly affect your paycheck, but it's notable. It could affect how much trust people put in these official numbers, and it injects some uncertainty. For now, though, the data is what it is. Job growth is near stall speed. UK labour market. Signs of softening, but wages surge. Over in Britain, the labour market is also showing a bit of wear, though it's a nuanced picture. The UK's unemployment rate has crept up to around 4.2%, from lows around 3.5% a year or two ago. That's similar to the US trajectory, still low unemployment by historical standards, but clearly off the floor. There are indications of a rise in job seekers and a slight increase in redundancies, layoffs. For instance, vacancies, job openings, in the UK have been declining over the past several months, meaning companies are posting fewer new jobs. This typically presages slower hiring. Sectors like manufacturing and retail have flagged that they're not expanding payrolls as much. The Bank of England has been paying close attention to the labour data because a tight job market was a big driver of domestic inflation, through wage growth, and they wanted to see it cool. One key piece of data just on the horizon, due right after our week, on September 16th, is the latest official wages and unemployment figures for the June-August period. But we already know from the previous release that wage growth in the UK has been very strong. The most recent reading, for the 3 months up to June, showed average weekly earnings up 5% year-on-year, excluding bonuses. That is actually a multi-decade high pace of pay increases for Britain. If you include bonuses, wage growth was even higher earlier in the year, thanks in part to some one-off public sector pay settlements, etc. So British workers, after years of stagnant pay, finally saw bigger raises, but cruelly, it came during a time inflation was 8–10%, so in real terms they still lost ground. Only now, with inflation down to approximately 4%, does a 5% wage rise mean a real pay increase, around plus 1% real. That's a noteworthy development. Real wages in the UK might be rising again for the first time in 2 years if this trend holds, helping restore some spending power to households. Of course, it varies. Public sector workers, for example, had been lagging and are now catching up with some large negotiated raises after strikes, whereas some private sectors had bigger bumps earlier. However, the Bank of England actually worries about wage growth at 5%. They see it as too high to be consistent with 2% inflation in the longer run. Their theory: if wages keep rising 5%, businesses will either keep raising prices to cover costs or their profit squeeze will force cuts elsewhere. Thus the BO has been hoping that as the job market loosens, wage growth will start to drift down towards, say, 3%. There are early hints this could be happening. Recruiters report pay for new hires isn't climbing as crazily as it was, and some surveys show employers' pay settlement expectations for next year are a bit lower. Still, in the here and now, the UK has something like the fastest nominal pay growth in the G7, which is a bittersweet accolade given inflation. Let's not forget, behind these numbers are real workers and potential labor strife. The past year saw numerous strikes and pay disputes in Britain: railroad workers, nurses, teachers, junior doctors, bus drivers, you name it, as they fought for inflation-matching raises. Many of those have been resolved with significant pay hikes, though often below inflation, effectively pay cuts in real terms. This week didn't see any massive new strikes start, but the undercurrent remains. Workers are still demanding better compensation now that labor markets have been tight. For instance, just outside our week, it's reported that train drivers are staging more walkouts in late September. Unions argue that with corporate profits up and inflation high, workers deserve their share. How this gets resolved will influence wage trends ahead. If the economy slows sharply, workers may lose some leverage, fewer strikes, smaller raises. If it muddles through, we could see continued upward pressure on wages. One more perspective. Productivity, output per worker, in the UK has been pretty flat, so rapidly rising wages without productivity gains mean higher labor costs per unit, which companies often offset by raising prices. This dynamic is part of why the bow is cautious. Europe and global bits. While our focus is US, UK, it's worth noting Europe's largest economy, Germany, narrowly avoided a recession earlier this year, but its manufacturing is weak, leading to some job cuts there. And globally, many labor markets that were ultra-tight are easing a bit. For example, the tech sector globally went from labor shortage to surplus last year, with lots of layoffs in big tech companies. By 2025 that stabilized somewhat. In the US, tech and some white-collar industries had layoffs in late 2024, but by mid-2025 most of that had worked through, and now it's more of a broad slow hiring scenario than big headline-grabbing layoff announcements. Oh, and speaking of minimum wages. A quick note, several US states have scheduled minimum wage increases for 2025, some as of January. Some like Florida even in late 2025 stepping up to $14 per hour. And big companies have continued raising their own internal minimum pay. For instance, Bank of America, we mentioned them earlier, confirmed it reached a $24 per hour minimum for its employees this year, on track to $25 next year. Moves like that don't immediately show up in average wage data but are important for many workers' personal finances. More money in the paycheck, less pressure on budgets. In the UK, the statutory minimum wage, national living wage, will also likely increase next April. By law it tends to rise each year, often by significant percentages recently to catch up with inflation. So lowest paid workers should see some relief. Labor market outlook. Summing up, the US labor market in this weekly window looks like it's hitting the brakes, which has major implications. It's good news for inflation, less wage pressure, less spending to drive prices up, and perhaps good news for prospective homebuyers. We saw mortgage rates dip partly due to this, more in the housing section. But it's potentially concerning news for job security. If you've been considering a job change or asking for a raise, bear in mind the environment is shifting. It might not be as easy now as it was a year ago to leverage multiple offers. For those in very in-demand roles, say, specialized healthcare, or skilled trades where there's still shortages, you're probably still in a decent spot. But if you're in an industry facing cuts, manufacturing, maybe finance or tech, updating that resume and building an emergency fund is wise. In the UK, unemployment is inching up but not spiking, so it's more a gentle cooling. Many businesses are still reporting staff shortages in certain areas, like hospitality, so it's a mixed bag. Some workers still have bargaining power, others might find it takes longer to get a new job if they lose theirs. The hope is that any rise in UK unemployment remains modest, perhaps drifting to mid-4% range, rather than anything severe. For now, central banks actually somewhat welcome this cooler labor landscape, less risk of an overheated economy. But for households, it's a time to stay vigilant. Job security and income growth are less of a sure thing than they seemed during the post-pandemic boom. The best personal finance advice in such times is to avoid taking on excessive new debt on the assumption of future raises or bonus. Those might not come as easily. Live a bit within your means, and if you're on the job market, be prepared that the hunt may take longer than in the recent past. With the economy at an inflection point, how have the stock markets and investments reacted? Time to talk markets, because our 401ks, IRAs, and ISAs have had a bit of a ride too. Investing and market movements. Stock markets hold steady, more or less. Given all the economic cross-currents, one might expect a lot of drama in the stock markets. But interestingly, this week equity markets in both the US and UK were relatively calm and even inched higher in some cases, thanks to hopes of those central bank rate cuts we discussed. Let's start in the US. The benchmark S&P 500 index ended the week with a modest gain of around plus 0.3%. It wasn't a blockbuster rally by any stretch, but it's notable that stocks managed gains at all considering the mixed economic data. Tech stocks in particular had a decent week. The Nasdaq Composite rose about 1%, continuing a trend we've seen where investors pile into big technology names whenever interest rate outlook improves. Why? Because lower interest rates increase the appeal of growth stocks, like tech companies, which are valued on future earnings. In fact, one of the week's standout movers was Alibaba, the Chinese e-commerce giant, which isn't a US company per se but is traded on US exchanges. Its stock jumped double digits, reportedly around 14% weekly gain, due to some company-specific news and the general rebound in Chinese tech sentiment. That helped lift some emerging market funds and tech-oriented portfolios. Over on Wall Street, sentiment was buoyed midweek by that slowdown in inflation and labor data hinting at Fed easing. You could almost hear traders cheer, "Bad news is good news." Meaning bad economic news, slow jobs, was interpreted as good news for Fed policy, rate cuts, which is good for stocks. Classic late-cycle stock market thinking. There was a bit of a wobble on Friday as some investors likely took profits and digest the data fully, and perhaps worried that a very weak economy isn't actually great for corporate earnings. But overall, volatility remained low. The VIX index, Wall Street's fear gauge, stayed pretty subdued, indicating not much panic or expectation of big swings in the near term. Sector-wise, interest rate-sensitive sectors like utilities and real estate investment trusts, REITs, got a small boost from falling bond yields. More on bonds in a second. Meanwhile, financial stocks were relatively flat. Banks aren't thrilled about rate cuts since higher rates had been boosting their interest margins, but at the same time, a healthier economy, if the Fed avoids recession, is good for them. It balances out. One negative spot. Some energy stocks pulled back as oil prices, which had risen earlier, stabilized. But oil remains relatively high, so energy companies are still generally doing well compared to earlier in the year. Bonds and yields. In the background, the bond market was a driver of some stock moves. Treasury yields fell this week, bond prices up, reflecting those rising expectations of Fed cuts. The 10-year U.S. Treasury yield, for example, dipped to around 4.1% from roughly 4.25% the week before, one of the largest weekly drops in a year. In fact, mortgage rates, which track the 10-year yield loosely, experienced their biggest one-week drop in about a year, as we'll detail in housing. Lower yields make stocks comparatively more attractive, since the risk-free return falls, hence supporting equity valuations. Across the pond, FTSE near record. In the UK, the FTSE 100 index, which comprises the largest companies on the London Stock Exchange, had an interesting week. By Friday's close, the FTSE 100 was hovering very close to all-time record territory. It did slip a bit on the last trading day, down about 14 points on Friday, ending just below a recent peak, but it remains near historic highs around the 9,280 mark. Yes, you heard that right. Despite all the UK economic woes in recent years, the FTSE is flying high. How so? Remember, the FTSE 100 is full of multinational corporations, many in sectors like oil and gas, mining, pharmaceuticals, and finance, that have benefited from global trends, like strong commodity prices, or a weaker pound boosting their overseas earnings when converted back to GBP. Also, when UK bond yields dipped in anticipation of the BOE holding rates, it made dividend-paying FTSE stocks more appealing. This week, the FTSE's slight pullback on Friday was attributed to downbeat economic data. Earlier that day, likely the news that UK GDP stagnated in July, no growth, versus an expectation of maybe a small uptick. That made some investors take profits, thinking a slowing economy could eventually drag on corporate profits. But the decline was minor. For the week overall, UK indices were flat to slightly up. The mid-cap FTSE 250, more UK-focused firms, has been more sensitive to domestic trends and was a touch softer, reflecting UK-specific growth concerns. One fun fact: if you only read economic headlines, high inflation, slowing growth, etc., you'd be surprised to see stock headlines, FTSE at record highs. It's a reminder that stock markets sometimes march to a different drummer. Part of it is that they look ahead, perhaps hoping things will improve, and part is the composition of indices, global firms doing well even if local economy is tepid. Elsewhere in markets, other asset classes worth mentioning: gold prices remained relatively stable around the mid-1900s per ounce. Gold often benefits from lower real yields and economic uncertainty, so it has been well supported, though not making new highs this week. Oil hovered in the mid-80s per barrel, Brent crude, which is relatively high and has implications for inflation, but there was no big oil price shock or drop this week. It was mostly steady after a rise in prior weeks. High oil is good for oil company stocks, BP, Shell, big FTSE components, but bad for consumers' wallets. We'll see if it keeps creeping up or stabilizes. Crypto Corner. If you're into cryptocurrency, Bitcoin and friends had a quiet week in the grand scheme, with Bitcoin trading around the mid-$25,000 to $26,000 range. It's been relatively uneventful as the crypto market waits for potential regulatory decisions, like a possible Bitcoin ETF approval in the US, and reacts somewhat to tech stock movements. It wasn't a headline driver this week for mainstream personal finance, which is frankly a relief after the rollercoaster of previous years. Investor sentiment and themes. The overarching theme in markets was stagnation or soft landing. For a while, there's been a fear of stagflation, high inflation plus low growth, something central banks dread. But what we may be seeing is more stagnation instead of stagflation, meaning inflation is easing as growth eases, which is more like a typical cycle. A Reuters piece even suggested the Fed's fear gauge is pointing to stagnation rather than stagflation, and stagnation, though not fun, is easier to cure with policy than stagflation. Investors seem to be coalescing around the idea that central banks will err on the side of supporting growth soon. That tends to put a floor under stocks. So despite a lot of bad news, higher unemployment, etc., stocks didn't tank. They've sort of priced in a mild slowdown as long as it means inflation gets tamed. Another interesting angle: currency moves. The US dollar slipped a bit this week against major currencies, including the British pound, which ticked up after the UK GDP data. Paradoxically, sometimes weak growth can weaken a currency, but in this case traders might have thought the data wasn't bad enough to stop the bow from eventual easing, or it could be technical moves. A slightly weaker dollar can be good for US multinational companies, helps their exports, boosts overseas profits in USD terms, and indeed the stock market tends to like a not too strong dollar. For UK investors, the pound's fluctuations influence imported inflation and travel costs, but we won't digress too much. Retirement and investment accounts. If you peeked at your 401k or IRA balance after this week, you likely saw a small uptick, assuming you hold broad equities. Likewise, UK pension funds, often heavily invested in FTSE equities and bonds, would have seen a gentle rise in asset values. Bond funds, which had a tough time in 2022-2023 as yields rose, actually saw gains this week as yields fell. That's a sign that balanced portfolios benefited on both the stock and bond side, a relief for the traditional 60/40ths portfolio advocates who had a rough patch when both stocks and bonds fell together last year. For now, that negative correlation is back. Bad economic data and GT. Yields down, bonds up. But stocks not too hurt because central bank will cut and GT, stocks up. That's the old seesaw working nicely, at least for 1 week. Risks on the horizon. Of course, not everything is rosy. Corporate earnings growth has been slowing and in some sectors, like manufacturing or some retail, could decline if consumer spending decelerates. Student loan payments resuming, as noted, could trim some corporate revenues, maybe in discretionary retail or services. There's also the elephant in the room: US government potential drama. At the end of September, the US government faces a funding deadline, and if Congress doesn't pass a budget or extension, a partial government shutdown could occur in October. That didn't spook markets yet, but as the date nears it could inject volatility. In the UK, political uncertainty is simmering as well, with a general election due in 2024 and parties already positioning, tax policy, etc., which we'll mention in the policy section, can affect certain stocks or sectors. For everyday investors, the takeaway is diversification and patience. The markets are currently being pushed and pulled by every data release. One day we cheer weak data because it means easier money. Another day we might fret that the data is too weak, meaning profits will suffer. It's a time when having a balanced portfolio helps smooth the ride. For instance, someone diversified globally might benefit from US tech doing well and also from UK dividend stocks near record highs, plus bond interest ticking in. In summary, investors largely kept their cool this week. No wild swings, some cautious optimism that the fabled soft landing, where inflation comes down without a severe recession, might actually happen. Stocks are not far off their highs in the US and at highs in the UK, which suggests a lot of good news is already priced in. That means there's also risk of disappointment if, say, inflation flares up again or earnings drop. But for now, the trajectory is okay. If you're investing for the long term, weeks like this are a reminder not to get too caught up in day-to-day noise. The broad trends, inflation direction, interest rate cycle, economic growth, matter more. And on those, this week brought more evidence that we're transitioning to a new phase, the post-inflation scare, slower growth, lower rate phase. Now, markets aside, let's focus on what governments and regulators have been up to. There were a few policy shifts and proposals this week that could directly affect personal finances, from tax credits to tariffs to financial regulations. That's it for Part 2B. We looked at how consumers are behaving and how markets are reacting. In Part 3, we'll cover government policy changes, corporate moves, housing, and even cultural money shifts. Stick around, it's where personal finance meets politics and culture. Comment below. Are you cutting back spending this fall, or still spending strong?